Here's the truth about buying a home that most people don't want to hear. Most buyers are completely unprepared. In this video, I'm going to walk you through the entire home buying process in 12 steps. Most buyers think all they need to worry about is the down payment and the interest rate, but those are not the biggest risks. The biggest risks are the hidden costs, the fine print in mortgage contracts, and the financial pressure that comes after you get the keys. Stick around, and by the end of this video, you'll know exactly what to expect, what mistakes to avoid, and how to decide if buying a home is actually the right move for you. We're going to start with a step that most people skip. Step 1, evaluate your financial readiness. The first step in buying a home has nothing to do with house hunting. It's figuring out whether you're truly ready financially. Having a down payment alone does not mean you're ready. This is one of the biggest mistakes buyers make. There's also closing costs when you buy a home. There's property transfer tax, legal fees, appraisal or inspection fees, etc. Home ownership comes with much more than just a mortgage payment. You will have property taxes, insurance, utilities, maintenance costs, and unexpected repairs. And life events don't just stop because you bought a home. That's why real financial readiness means having an emergency buffer at the time of purchase and an emergency fund after closing. Ideally enough to cover 3 to 6 months of expenses. Buying a home should make your life more stable, not totally consume it. Step 2, save and structure your down payment. In Canada, you do not need 20% down to buy a home. That's one of the biggest misconceptions. You can buy with less, and you don't even have to be a first-time buyer. Note that a minimum of 20% down payment is typically required for dedicated investment or rental properties because they are not eligible for mortgage default insurance. Less than 20% down is generally reserved for primary residences, although there are some exceptions. So if your down payment is under 20%, mortgage insurance becomes mandatory. This insurance protects the lender and not you, and it gets added to your mortgage balance. This is between 2.8 to 4% of the mortgage amount, with the amount increasing the less that you put down. So for example, if you put the minimum 5% down, the mortgage insurance premium will be at the highest at 4% of the mortgage amount. So let's take a look at a quick example.
So let's say you have a purchase price of $500,000 and you put a down payment of 5%, which is $25,000. Your mortgage is $475,000 plus the mortgage insurance premium. In this case, it would be $19,950, making your total mortgage $494,950.
That means you will pay interest on that over time. However, waiting years to save a larger down payment isn't always the smartest move. Sometimes entering the market earlier, even with insurance, can be financially beneficial in the long run, but it's case by case. Canada also offers powerful saving tools like the First Home Savings Account and the RRSP withdrawal program that you can help accelerate your down payment. So I'll do a separate video explaining how these programs work, so keep an eye out for that. The key is not just saving money, it's choosing the right timing and strategy. Step 3, learn the fundamentals of mortgages. A mortgage loan is simply a loan secured by your property. But unlike most debts, it builds ownership over time. In the early years, most of your payment goes towards interest. Later, more of it goes towards principal. This gradual shift is one of the main reasons home ownership has historically helped Canadians build wealth. Not because prices always go up, but because over time, your payments turn into equity. So understanding this concept changes how you see a mortgage. It's not just debt, it's a long-term financial tool. One of the most important mortgage decisions you'll make is choosing between a fixed rate and a variable rate. A fixed rate provides stability. Your payment stays the same. It's predictable, which makes budgeting easier. But fixed mortgages come with higher penalties if you need to break them early. A variable rate changes in direct response to fluctuations in a lender's prime rate, which is heavily influenced by the Bank of Canada's policy interest rate. So when the Bank of Canada raises or lowers its policy rate, the lender's prime rate shifts, subsequently increasing or decreasing the interest rate on the variable loan. Some lenders have adjustable payments that rise or fall. Others keep the payment the same, but shift how much goes toward interest. There is no universally best option. The right option depends on your risk tolerance, financial flexibility, and future plans. For example, if you're risk averse, strict on budget, and plan to stay in the property long term, fixed may be better. And if you're comfortable with risk, given there could be potential savings, and not really sure how long you plan to stay, variable might be more attractive. What matters most is choosing a mortgage that fits your lifestyle, not just chasing the lowest rate. There's also another variable product option that some homeowners consider, a home equity line of credit, also known as a HELOC. A HELOC allows you to borrow against the equity in your home, and equity simply means the difference between what your home is worth and what you still owe on the mortgage. For example, if your home is worth $800,000 and you owe $500,000, you may have up to $300,000 in equity. And a HELOC gives you access to a portion of that equity as a revolving line of credit. So instead of receiving one fixed lump sum like a traditional mortgage, you are approved for a credit limit that you can borrow from, repay, and borrow from again. It's revolving. In Canada, most lenders will allow you to borrow up to 80% of your home's value between your mortgage and your HELOC combined. However, the HELOC portion itself is usually capped at 65%. Now, here's how a HELOC differs from a regular mortgage. With a traditional mortgage, you borrow a fixed amount up front, and every payment includes both principal and interest. So over time, your balance gradually decreases. With a HELOC, you typically make interest-only payments on the amount you've actually borrowed. The principal does not automatically reduce unless you actively choose to pay it down. Typically, HELOCs also have a variable rate, so the rate can move up or down depending on changes to a lender's prime rate. So while a HELOC offers flexibility, it also requires discipline. It can be useful for renovations, emergency access to funds, or strategic investing. But because it is secured by your home, mismanaging it can increase financial risk. Some lenders also offer what's called a readvanceable mortgage. This combines a traditional mortgage and a HELOC into one product. As you pay down your mortgage principal, your available HELOC limit automatically increases, and this can provide ongoing access to equity over time. But again, it should be used strategically and responsibly. Like fixed and variable mortgages, a HELOC is simply another tool. The key is choosing the right product based on your financial goals, risk tolerance, and long-term plan. Step 5, apply the product penalty price rule. Most buyers choose a mortgage based only on interest rate, but that's often a very expensive mistake because many low-rate mortgages often come with severe restrictions and huge penalties. A smarter approach is to follow this order. First, choose the right product for your needs. Second, understand the penalties and flexibility. And third, compare interest rates. Before you choose a mortgage product, there are a few key terms you absolutely need to understand, because these terms directly impact how much you pay and how flexible your mortgage really is. Let's start with amortization versus the term for your mortgage. Amortization is the total length of time it would take you to fully pay off your mortgage if you never changed anything. In Canada, the standard amortization is 25 years. That does not mean you have a 25-year contract. It simply means that at your current payment schedule, the mortgage would be fully paid off in 25 years. Now, if you choose a shorter amortization, for example, 15 or 20 years, your monthly payments will be higher, but you will pay significantly less interest overall. On the other hand, if you extend your amortization to 30 years, your payments will be lower. However, you will pay more interest over the life of the mortgage. Lower payments sound attractive, but they come at a long-term cost. Now let's clarify the difference between amortization and term. The term is the length of your actual mortgage contract. This is typically between 1 to 10 years in Canada, with 5 years being the most common. At the end of your term, you renew your mortgage either with the same lender or a different one. Side note, the end of your term is the best time to switch lenders or make changes to your mortgage, for example, through refinancing to access equity available, because at this time, there is no penalty. So when someone says, I have a 5-year mortgage, that's not technically correct. They usually have a 25-year amortization with a 5-year term. Now let's talk about principal. Principal is simply the amount you borrowed and still owe, and every payment you make includes interest and principal. In the beginning, most of your payment goes toward interest, but over time, more goes toward principal. And the faster you reduce principal, the less interest you pay long term. How can you pay down your principal faster? Well, there are a few strategies. First, switching to accelerated biweekly or weekly payments instead of monthly payments. This is a small adjustment that can reduce your mortgage by up to 2 to 3 years over time. Second, using your prepayment privileges. Most mortgages in Canada allow you to make extra lump sum payments or increase your regular payments by 15 to 20% without any penalty. These are often referred to as the 15-15 or 20-20 privileges, and using these wisely can dramatically shorten your mortgage timeline. But here's the caution. Do not squeeze out every dollar you have aggressively to prepay your mortgage. Once money goes into your mortgage, it is not easily accessible. Always keep an emergency fund separate because liquidity matters. Now let's talk about open versus closed mortgages. A closed mortgage has lower interest rates, but if you break it before the term ends, you will face a penalty. This is what most Canadians choose because it's cheaper month to month. An open mortgage allows you to pay it off at any time without any penalty, but the interest is higher. Open mortgages are typically used if you know you will sell or refinance within a short time frame, usually between 18 to 24 months. Otherwise, it's usually more expensive overall. Now, here's where things get serious. Mortgage penalties in Canada can be very large. There are 3 main penalty types. The first is a 3-month interest penalty. This is common with variable mortgages and is usually the least expensive type of penalty. The second is the interest rate differential, often called the IRD. This applies to fixed rate mortgages. It is calculated based on the difference between your original interest rate and the lender's current rate, multiplied over the remaining term. And this can be extremely expensive. In some cases, penalties can reach tens of thousands of dollars. The third type is a flat fee penalty. This is more common with private or alternative lenders. And depending on the situation, it can sometimes be higher than the 3-month interest. This is why I always emphasize what I call the 3P rule. When choosing a mortgage, prioritize product first, then understand the penalty risk, and only then compare the price, meaning the interest rate. Because the wrong product with the lowest rate can cost far more than slightly higher rate with a better flexibility. And this is one of the biggest differences between informed buyers and reactive buyers. By the way, if you're finding this information helpful so far, please don't forget to hit that like and subscribe button. I know it seems like a lot of steps, but stay with me because you'll thank me later. Step 6, secure a fully verified pre-approval, or what my team and I like to call a bulletproof pre-approval. This step is critical, but most people misunderstand it. A true pre-approval means your financial documents has been reviewed and are checked off either by a lender or a mortgage broker. This includes paperwork for your income, your debts, your credit, and your down payment. It's not just an online estimate or pre-qualification. A proper pre-approval gives you an accurate and realistic budget and protects you from a deal collapse later. Because one of the worst experiences is finding a home that you love only to discover financing doesn't actually work. This step gives you clarity and confidence that should be done before you start shopping. Step 7, work with the right professionals. Buying a home is not a solo process. You will need a strong team. This typically includes a mortgage professional, a real estate agent, and a lawyer. A good agent doesn't just show homes. They help you avoid overpaying, identify risks, and negotiate effectively. A strong mortgage professional ensures that you choose the right product and financing strategy, while a lawyer protects your legal interests during closing. The quality of your team can significantly impact your experience and the outcome, so do your due diligence in advance and read testimonials. Step 8, search for homes with discipline. Once you're pre-approved, then you can begin house hunting. But one important rule applies. Just because you're approved for a certain amount, it doesn't mean that you should max it out. Lenders calculate maximum affordability, not lifestyle comfort. They don't consider your desire for travel, expensive hobbies, or multiple kids' activities. And smart buyers create financial breathing room to maintain flexibility and peace of mind, because owning a home should support your life, not totally limit it. Step 9, submit an offer with protection conditions. When you find a home, you submit an offer, and this stage includes conditions that protect you. These can include financing approval, home inspection, appraisal, and property document review. Never skip these steps because even new homes can have issues. Due diligence protects you from costly surprises. Step 10, complete the full lender approval process. After your offer is accepted, the lender conducts a full review. This is when your pre-approval turns into an actual approval. They assess your income, your credit history, down payment, property value, and any other documentation. The property itself must also meet the lender's standards. If the appraisal comes in lower, the lender may reduce the mortgage amount. While this is frustrating, this often protects you from overpaying and gives you the confidence on the property's value. Step 11, finalize the purchase with a lawyer. During the closing stage, you sign legal documents and transfer the remaining funds. You will pay closing costs such as legal fees, land transfer tax, and title insurance. Once everything is completed, ownership transfers to you and you receive your keys. This is an exciting moment. But financially, it's only the beginning of home ownership. Step 12, manage ongoing home ownership expenses. After moving in, many new homeowners experience surprise costs. So beyond your mortgage, you will pay for property taxes, insurance, utilities, maintenance and repairs. And over time, large expenses like roofs, appliances, and renovations will arise. That's why realistic budgeting is essential for long-term success. This is why evaluating your financial readiness in step 1 and having an emergency fund after you buy is crucial. Buying a home in Canada can be one of the most powerful financial decisions that you will make. It can create stability, long-term wealth, and personal security, but it is not risk-free. It requires preparation, discipline, and informed decision-making. The goal is not simply to buy a home. The goal is to buy a home that fits your life financially and emotionally for years to come. I'm Evangeline, mortgage broker and partner at All Trust Mortgage Solutions here in Greater Vancouver. And if you learned some new things from this video, hit that like and subscribe button to help it reach more people. I'd love to continue the conversation, so drop your questions in the comments below.